There is a moment in most people's careers when everything they were told about hard work and reward stops making sense. It usually arrives 3 months after the promotion, the celebration has settled, the new business cards have been ordered, the LinkedIn update has been posted, the dinner out has been had, and then the first full payslip under the new title arrives, and the number at the bottom, the number that was supposed to reflect the years of effort, the extra hours, the performance. Reviews that finally said yes is smaller than expected. Not the gross number. The gross number is fine. The gross number is exactly what they promised. The net number. The number that actually arrives in the bank account. Meet Daniel, 31 years old, just promoted to marketing. Manager, 3 months ago he was the most excited person in his building. Today he is staring at a payslip trying to understand why a promotion that added $6,000 to his gross annual salary has added less than $80 to his monthly take-home. Meet Claire, 34 years old, accountant, same company as Daniel. 2 years ago she turned down a promotion that looked almost identical to the one Daniel just accepted. Everyone thought she was making a mistake. She was not. Today we are going to show you exactly why getting promoted is one of the most financially misunderstood events in the working life of an ordinary earner, and why the system that benefits most from your promotion is not you. Daniel worked for this promotion for 3 years, not in an abstract, hoping it happens way, in a specific, deliberate, documented way. He asked his manager what promotion required. He was told, lead 2 major campaigns, mentor a junior team member, hit revenue targets for 3 consecutive quarters. He did all 3. When the promotion came through, he called it the moment his career had shifted into a different gear. His new gross salary was $68,000, up from $62,000, a $6,000 increase. He went home and calculated his new monthly take-home. The calculation took him 11 minutes. What it told him took the rest of the evening to process. After income tax at his new marginal rate, his monthly take-home from the additional $6,000 in gross salary was approximately $240 a month, $20 more per week, for a promotion that had taken 3 years of deliberate effort. But that was not the worst of it, because Daniel's promotion came with something else, a new title. Meant new professional expectations, a better work wardrobe, client entertainment, the unspoken requirement to project the image of his new seniority. In the first quarter alone, those costs absorbed 3 months of his additional take-home before he had noticed they were happening. And because Daniel's gross income had crossed a threshold, he had lost eligibility for 2 income-based tax credits he had been quietly receiving for 2 years without fully registering they existed. His promotion had not made him richer. By any honest calculation, it had made him measurably poorer in the short term, and had restructured his tax position in ways that would take years to recover from strategically. Claire had seen this coming 2 years ago. She had run the numbers on her own promotion offer before she responded to it. What she found in those numbers changed not just her answer, but her entire understanding of how the employment tax system is structured, and who it is actually designed to benefit. There are 4 mechanisms that make promotions financially dangerous for ordinary earners who take them without calculating. Here is what we are covering today. First, the tax bracket cliff. Why crossing an income threshold can result in a marginal tax rate that consumes the majority of your raise before it reaches your account, and how the system is structured to ensure this happens quietly. Second, the benefit phase out. The government benefits, tax, credits and income-based entitlements that disappear as your gross income rises, often worth more than the promotion itself. Third, the status cost. The invisible professional spending that a new title generates and why it almost always exceeds the additional net income in the first year. Fourth, the opportunity delay. how accepting the wrong promotion at the wrong time can delay your most important financial moves by years. Let us begin.
Daniel's promotion added $6,000 to his gross annual salary. Here is what happened to those $6,000 before they reached his account. In Daniel's tax jurisdiction, and this mechanism exists in every major English-speaking country in some form, income is taxed in bands. The first band of income is taxed at a lower rate, the next band at a higher rate.
The highest band at the highest rate. Daniel's previous salary of $62,000 sat comfortably within a mid-range band. His new salary of $68,000 crossed a threshold, not by a large amount, by $6,000. Here is what that crossing means in practice. The $6,000 increase is not taxed at the rate that applied to his first $62,000.
It is taxed at the marginal rate of the new band, the higher rate that now applies to every dollar earned above the threshold.
In Daniel's case, that marginal rate on the additional $6,000 is 41%. 41% of $6,000 is $2,460 paid in additional tax. His net gain from the promotion after tax, $3,540 annually, $295 per month. That is the headline number, but it is still not the real number, because the tax bracket cliff interacts with everything else in his financial structure simultaneously. Before his promotion, Daniel had been making voluntary retirement contributions that qualified for tax relief at his lower band rate. After his promotion, the same contributions attract the same nominal relief, but the effective benefit changes relative to his new marginal position.
The retirement strategy that made sense at 60. $2,000 requires recalibration at $68,000. A recalibration Daniel had no idea he needed to make. Claire understood this before she responded to her promotion offer. She calculated her exact marginal rate on the additional income. She calculated the interaction with her retirement contributions. She calculated the effective net gain after every tax adjustment. Her promotion would have delivered $180 per month in real additional take-home.
She asked her employer if there was an alternative structure, a combination of base salary increase and additional employer pension contribution that could deliver more real value at lower marginal tax cost. There was. It took one conversation, 1 hour of preparation. 1. Understanding of how the tax bracket cliff worked. Daniel never had that conversation because Daniel did not know.
The cliff existed until he was already on the other side of it. The system does not hide the tax bracket cliff, it simply does not explain it. And nobody in the HR department that delivered Daniel's promotion letter was paid to run his tax calculation before handing him the envelope. Here is a category of financial support that most ordinary earners receive without fully registering it. Tax credits, income-based entitlements, housing support, calculations, childcare subsidy eligibility, student loan repayment, thresholds, energy bill support programs. Every one of these exists on a sliding scale. As income rises, they reduce. At certain thresholds, they disappear entirely. Daniel had 2 of them.
The first was a working tax credit that he had been receiving for 2 years, worth approximately $94 per month. It had been applied automatically to his tax account without any action required from him. He knew it existed in the way you know about a direct debit you set up years ago, present but not examined. When his gross income crossed the threshold created by his
promotion, the credit began phasing out. By the end of the tax year, it would be gone entirely. $94 per month.
$1,128 per year, gone. The second was a childcare subsidy that applied to his income bracket, worth approximately $60 per month, also phasing out at his new income level. Together these two benefits were worth $154 per month, $1,848 per year.
Daniel's promotion had added $295 per month in additional net salary after the tax bracket cliff. It had simultaneously removed $154 per month in income-based benefits. His real net gain from the promotion, $141 per month, $1,692 per year, from a promotion that required 3 years of deliberate performance to achieve. This is the benefit phase out. It is one of the least discussed and most financially significant aspects of moving through income. Thresholds.
The tax bracket cliff gets occasional coverage. The benefit phase out almost never does, because the benefits disappear gradually, not in a single dramatic moment, and because most people do not track them closely enough to notice when they begin to reduce. Claire had mapped every income-based benefit she received before. Evaluating her promotion offer, she knew the exact threshold at
which each one would begin to phase out. She knew the combined monthly value of everything at risk. Her promotion would have cost her $212 per month in phased out benefits, more than the entire net salary gain of $180. Her promotion would have made her $32 per month poor in net terms before the status costs arrived. That was the number that made her decision straightforward. Daniel made his decision without this number. He did not even know it was a number he needed.
Daniel's new title is Marketing Manager. In his company, in his industry, in the professional culture he works within, that title carries expectations, not explicit ones. Nobody handed him a document listing the required expenses of his new seniority. Nobody told him he needed to upgrade his wardrobe, that he was now expected to pick up the tab at client lunches, that attending industry events was no longer optional networking, but professional obligation.
Nobody told him, but everyone around him understood it, and over the first 3 months of his promotion, Daniel spent accordingly, in the way people spend when they are following an unspoken social contract they never agreed to sign. A new suit, $480, 2 dress shirts and formal shoes, $310, 3 client lunches where the new manager paid, combined to $160, an industry conference his previous role had never required him
to attend, registration and travel, $340, a professional association membership his new title was assumed to include, $120 per year. First quarter status costs, $1,510. His first quarter additional net take home from the promotion, $423. The status cost had consumed 3.5 months of his promotion's financial benefit in 90 days. And this was not reckless spending. This was not lifestyle, inflation in the traditional sense. Daniel had not bought anything he personally wanted. He had bought what his new position socially required, and the price of entry into that position had been more than the position itself had paid him.
The status cost is not unique to Daniel's industry. It operates in every professional environment where titles carry social weight. The higher the title, the higher the unspoken cost of performing it credibly. Claire had estimated her status costs before accepting or declining her promotion offer. She had spoken to 2 colleagues at the level she was being offered. How much did the role actually cost to occupy? What were the wardrobe requirements, the entertainment, expectations, the event obligations? The answers added $460 per month to the real cost of her promotion. $460 per month in status costs, against a net gain of $180 per month in additional take-home, before the benefit phase out. The promotion would have cost her $644 per month more than it paid her. She sent a polite and considered response to her employer. She was not ready to accept the role at this time, but would welcome a conversation about the conditions under which it would make. financial sense for her to do so. Her employer appreciated the professionalism, and 2 years later, when the promotion structure had been renegotiated into a package that actually delivered positive net value, she accepted it. Daniel is still calculating. There is a financial move that Daniel has been planning to make for 18 months. Not a dramatic move, not a get-rich scheme. A straightforward first investment, a modest index fund contribution, set up monthly, designed to begin the compounding cycle before his 30s run out. He has the account set up, he has researched the platform, he has chosen the fund. What he has never had is the margin.
Every month something has absorbed the $300 he had mentally allocated to this move. Before the promotion it was the general tightness of his income. After the promotion it has been the tax restructuring, the benefit losses, and the status. Costs that consumed his additional take-home before it could be redirected. The investment has been delayed for 18 months. This is the opportunity delay.
It is the least visible cost of the promotion trap, because it is not a cost that appears on any statement. It is the absence of a gain, the compounding return that was never generated because the capital that should have funded it was consumed by the structure of the promotion itself. Here is what that delay cost Daniel in real terms. $300 per month invested from age 29 at a conservative 6% annual return compounds to approximately $69,000 by age 45. $300 per month invested from age 32. The age Daniel will be if the delay continues another 18 months, compounds to approximately $53,000 by age 45. The opportunity delay cost Daniel $16,000. Not because he spent it, not because he made a bad decision, because the promotion that was supposed to accelerate his financial life consumed the margin he needed to begin it. Claire understood the opportunity delay before she declined her promotion. She had identified her first investment move. She knew the monthly amount. She knew the compounding impact. She knew exactly what a 12-month delay in starting it would cost her by age 45. When she evaluated her promotion offer, she asked one question. Does accepting this promotion allow me to begin my investment move within 3 months, or does it delay it?
The answer, given the tax cliff, benefit phase out and status costs, was that it delayed it by at least a year. The opportunity cost of that delay was greater than the cumulative net financial benefit of the promotion over its first 3 years. She declined. Daniel accepted without asking the question.
He is 31 years old, and his first investment move is still sitting in a browser tab he opens every few weeks and closes again when the margin is not there. The promotion was supposed to create the margin. It consumed it instead. Claire did not turn down her promotion because she lacked ambition. She turned it down because she had run 4 numbers that Daniel never ran, and those 4 numbers told her that accepting the offer as structured would make her measurably poorer for at least 2 years before she recovered the ground. The 4 numbers were not complicated.
The first was her marginal tax rate on the additional income, not the headline rate, the effective rate on the specific dollars the promotion was adding. That calculation took 20 minutes. The second was the combined monthly value of every income-based benefit she currently received, and the exact income threshold at which each one would begin to reduce. That took 1 evening and 1 government benefits calculator.
The third was a realistic estimate of her status costs, based on conversations with 2 people already in the role, not assumptions. That took 2 conversations over 2 lunches. The fourth was her opportunity cost, the monthly investment she had planned to begin, and the compounding impact of delaying it by 1 year versus proceeding on schedule. 4 calculations, 1 decision. The calculations told her the promotion as offered was not worth taking. They also told her exactly what a worthwhile version of the promotion would look like, how it needed to be structured in terms of gross salary, employer pension contributions, and professional expense allowances to deliver genuine net positive value. She negotiated from that position. 2 years later, she accepted a restructured offer that met her real criteria. Daniel can run the same 4 calculations today, not to turn down his promotion, it has already been accepted, but to understand exactly what his financial position now requires, to recover the ground the promotion has cost him, to negotiate the next step from a position of real knowledge rather than assumed reward. The promotion system is not designed to explain itself, but it can be understood by anyone willing to run the numbers before the celebration. Daniel is not naive. He is not financially irresponsible. He is not someone who failed to plan or think ahead. He is someone who was never given the information that would have made his planning complete. The promotion system assumes you understand its mechanics. Your employer assumes you have calculated the real net value of what they are offering. The tax system assumes you know what thresholds you are crossing and what disappears when you cross them. None of them explain it. And so millions of people accept promotions that cost them money, celebrate milestones that set them back, and spend years wondering why the career progression that was supposed to build there. Financial life has left them exactly where they were. Claire is not smarter than Daniel. She simply ran the numbers before she gave her answer. Daniel can run them now. So can you. Because the promotion is not the trap. Not knowing what the promotion actually pays you, that is the trap. And you just learn what to calculate.
If this video showed you something about your own salary structure that changes how you think about your next performance review, share it with someone who is about to say yes to a promotion without running the numbers first. Because the promotion trap is one of the most expensive things that happens to people who work hard and deserve better. Subscribe to WealthBeyond for a new money truth every single week. No shortcuts, no investment noise, just the real financial mechanics behind the working life you are already living. And if you want to start building a clear picture of your own real take-home, the link to our free savings goal calculator is in the description below. We will see you next week.